Welcome to the Hollow Point Trading Market Brief for June 1st, 2026. Today we'll discuss all-time highs, the capex arms race, and a two-sided tape. Remember, this is not financial advice. Our doctrine is simple. One lens, three pillars, zero noise. We follow the money, focusing on structure, not headlines. The goal is to know the level, the catalyst, and the plan, not to be right about an opinion. Please read this important notice. This video is for educational market commentary and is not financial advice. Trading involves substantial risk of loss, and past performance doesn't guarantee future results. Do your own work and manage your risk. Our framework is built on three pillars: macro, fundamental, and technical. Macro is the weather system, fundamental is the fuel, and technical is the trigger. Confluence, where all three align, is where Hollow Point takes the shot. Our method is top-down, index to sector to stock. First, read the broad tape for the index. Second, find the rotation in the sector. Third, hunt the stock with the cleanest structure within the leading group. Today's setup shows a two-sided tape. The bull case points to fresh all-time highs and widening breadth. The bear case includes reversal signals on the weekly charts and geopolitical risk in oil. Looking at the session scoreboard for June 1st, 2026, tech indices are up, while the Russell 2000 is a laggard. Crude oil is reacting to the Hormuz bid, and the VIX closed above 16. The tape bought tech, but internals hint at a second message. Section 01 focuses on the index level. We must tread the whole boat before picking a passenger. This sets the foundation for our top-down analysis. The NASDAQ 100 has plowed to a new record. We are counting a final fifth wave off the March 30th low. Price is extending, but note that the indicators are starting to lag, which is important for later analysis. Absolute volume surged at month-end per month start, indicating institutional positioning. This volume size is rare since the March 31st turn, suggesting fresh longs and window dressing ahead of retail interest. The S&P 500 printed a higher high, but with lower conviction, evidenced by a spinning top and lower highs on the RSI. This bearish divergence is a yellow light, suggesting a possible stall, but not yet a sell signal. The Dow is showing a potential reversal cluster forming. The chart includes a possible hanging man on bar 7 of a daily count, stacking with a 13-9 sequential pattern. Exhaustion is visible, which is supported by the weekly 9 count. The Russell 2000 lagged the green tape for big caps, dropping 0.46%. The weekly chart completed a 9 count last week. When generals advance but troops fall back, late cycle behavior is indicated. Breadth needs to come from software, not small caps, currently. The VIX is coiling under the highs, up nearly 5% for the day and closing above 16. A bullish divergence is attempting to complete, suggesting cheap insurance is being bought into a known catalyst window. Index breadth is widening, a bullish sign that broadens participation across the NASDAQ and S&P beyond mega-cap names. Institutions view this broadening as a green light to add to their positions, driving the June 1st flow. The sequential counts show an exhaustion stack with weekly 9 counts on NDX, S&P, and Dow. Daily charts are at 7 of 9 and could complete by Wednesday. This provides the bears with their cleanest structural argument. We see a rare, triple, and quadruple bearish divergence on the charts. RSI, MACD, money flow, and rate of change are all rolling over. This is happening simultaneously on daily, weekly, and monthly timeframes, suggesting a strong reversal signal. The Elliott wave structure suggests a finishing wave 5 off the March 30th low. If this wave is completing here, a reversal should occur with or just after the 9 count. The completion and divergence combination flips the bias from up to down. The 2000 template analogy involves a parabolic surge, followed by a approximately 20% air pocket. Back then, most damage occurred in 3 days. This template is a blueprint to respect, suggesting the potential for a rapid correction. Bitcoin has peaked and is down about 14.5%. Historically, BTC led equity turns by weeks, but this cycle, the correlation has flipped positive. If Bitcoin leads stocks down, there may be no free pass for the broader market. The index fork presents 2 clean tapes meeting at one decision point. The bull case relies on capex and software breadth, while the bear case fears a 9 count completion into an oil shock. The S&P approximately 7,470 area is the critical line in the sand. Here are the key index levels to watch. Monitor these critical points closely for validation or invalidation of the market theses. The bull synthesis suggests the market is floating due to record highs on expanding volume and broadening breadth, with software joining leadership. The capex arms race guarantees forward demand, and earnings are still rising. The bear synthesis indicates this could be the top. Weekly 9 counts and daily 7 of 9 suggest price exhaustion, combined with triple/quad divergences. VIX is coiling, and Bitcoin's positive correlation signals risk ahead of a known catalyst window. Moving to Section 02, the sector level, we look to find the rotation. Money is constantly moving somewhere, and identifying this flow is crucial to our strategy. The rotation map shows capital moving out of crypto, through hardware, and into software. Home builders are also seeing a quiet bid. Trading with this rotation is key to success. Analyzing the rotation thesis, capital is moving out of crypto due to MicroStrategy selling. Hardware still has legs, front-running the SpaceX IPO. Software is the new leader, with AI beneficiaries finally monetizing. Sector relative strength confirms the rotation map. Software is the clear relative leader, followed by AI semis and hardware. Analog and crypto are bleeding relative strength, affirming our strategy to follow the rotation. In semiconductors, the market leader, everything else broadens out from here. The group has held its range since Wednesday's bar down. When the leader leads again, the index gets permission to push higher. We are seeing internal rotation back to AI within semiconductors. Money is rotating out of analog names and back into AI semis. The 5/27 SOXX bar marked this handoff, meaning AI semis reclaiming leadership puts the market back in the driver's seat. The semiconductor ETF, SOXX, completed its weekly 9-count last week. Signals remain bullish for now, as a count complete doesn't mean an instant reversal. However, it adds semis to the list of exhausted weekly structures, so watch for a reversal bar. Computex provided a live catalyst for the sector. We saw a stated $20 billion eventual CPU ambition, a new chip announced already in production, and multiple price target raises. The catalyst window remains open, especially with the Vera partner reveal tying ARM and the AI roadmap together. The volume coming into IGV software is staggering, suggesting a higher high and month-end window dressing. This volume is indicative of the long and strong crowd piling in on June 1st, marking a genuine reversal, not just a dead cat bounce. We are seeing a software reversal with bottoms in, across key names. Palantir broke the down wedge. Monday.com rallied 14% off a low, and names like CrowdStrike and UiPath are proving AI upside. The complex has turned with Okta, Snowflake, and ServiceNow. Capital is now hunting for the next AI-exposed group that can still make money, as hardware has become expensive. Software monetization is showing up in earnings. The software bottom is key to broadening the entire index higher. Hardware is where the capital expenditure lands, specifically in servers, networking, and power. Dell and Lenovo have seen massive moves post-earnings. Hardware still has legs through the upcoming SpaceX IPO and the subsequent spending. The AI capex arms race is real. Alphabet's $80 billion raise for AI infrastructure sets a precedent. What one hyperscaler spends, the rest must match, meaning Meta, Microsoft, and Oracle now face pressure to spend too. Follow the capital expenditure dollar from the hyperscaler raise into compute, networking, hardware, and power/data centers. This is a competitive arms race that continues until earnings roll, not when the spend looks circular. Google raising $80 billion proves the competitive capex thesis. More raise means more product bought, tightening the loop. Critics call it circular, but it's competitive. No one can afford to be outspent. It's about maintaining dominance. Cybersecurity is experiencing a quiet squeeze, led by names like CrowdStrike, Palo Alto, and Fortinet. The top holdings represent about 40% of the CIBR ETF. Broadcom's after-hours gain adds more fuel to this trend. Crypto is rotating out, with Bitcoin down 14.5% from its peak. MicroStrategy selling is a headwind. Capital is hunting for new theses, and the big catalysts have largely played out in crypto. Beware of wrappers. Owning a company that owns the asset is not the same as owning the asset itself. Berkshire Hathaway's quiet tail points to homebuilders, with a bid for Taylor Morrison following positioning in Lennar. This signals a long-cycle housing tilt, which is a bet on real economy demand and diversification away from a tech-only market. Real estate presents a decade-long opportunity for builders, as people need homes and builders are profiting from inventory creation. Berkshire's involvement signals smart money diversifying from the heavy tech focus. The IPO dynamics around SpaceX, expected around June 12th, could cap the UFO space names due to new issue supply. The IPO market is showing signs of fatigue, and how SpaceX prices will be a wildcard for the entire group. The IPO fade is a repeatable edge. Price jumps dramatically post-IPO, and that gap is the opportunity. Dropping an anchored VWAP from the print and writing it down has worked on names like Coinbase and Rivian. Until a true price discovers, the structure favors the short side. Marvell, which we call the red-headed stepchild of Broadcom, operates in the same custom silicon arena. Marvell has a much smaller cap, about 1/10 of Broadcom's $2 trillion cap. This smaller cap suggests more potential upside for Marvell within the same theme, offering a way to play the Broadcom theme with higher beta. Looking at the sequencing of hardware versus software, hardware leads first as capital expenditure lands in metal. Names like Dell, Lenovo, and HPE are involved. Software leads next, showing monetization in companies like Palantir and Snowflake. This bottoming suggests a broadening of the index and is the current rotation's destination. The sector confluence matrix provides a synthesis of various sectors. AI, semis, and software are bullish, with strong fundamentals or improving macro environments. Hardware and cybersecurity are also bullish. Homebuilders are constructive, but analog and crypto require caution due to weak fundamentals and rolling technicals. The sector red highlights key strategies. We lean long on rotation winners like AI, semis, software, hardware, and cyber. Hardware strength indicates continued capex demand downstream. Treat homebuilders as long-cycle diversifiers. Avoid or short analog and crypto wrappers, as they are on the wrong side of the flow. Moving to the stock level, the focus is on the best name, best group, and cleanest structure before taking a shot. We are bound by rules and feared by trade. Nvidia is breaking out, reclaiming AI semi-trade leadership after Computex. Price target raises are stacking up, suggesting a strong continuation. With a market cap of around $5.3 trillion, the breakout from a large base signals significant momentum. NVIDIA's thesis is supported by its $5.3 trillion market cap, fresh price target raises to $300, and reclaiming all three moving averages. The Computex and Vera partnership reinforce its multi-year roadmap. The stock is back in the driver's seat for the whole tape. The key structure point is holding above the breakout level. AMD and Intel show opposite tape reactions to the same news. AMD held the 12-day moving average and closed above the open. Intel, however, closed below both the 12 and 22 for the first time. AMD caught the news, and Intel did not, creating clear pair trade asymmetry. Intel's breakdown detail shows closing under the 22-day moving average for the first time since the recent rally, marking a technical event. A perfect doji signals indecision. Relative to AMD, Intel is the clear laggard, highlighting pair trade asymmetry. ARM's licensing play continuation was enabled by a conference call read, allowing an after-hours entry. It was named as a partner on the new Vera chip. This is a licensing play leveraged to the hardware cycle, continuing its momentum without chasing. Dell and HPE are key hardware beneficiaries, with capex landing here. Dell went vertical post-earnings. HPE, driven by Juniper compounding at 135% year-over-year, shows calls ending near 66, signaling a potential gamma watch and a real squeeze if it moves over 66 tomorrow. Lenovo demonstrates live hardware demand, being a direct beneficiary of escalating hyperscaler capex. It confirms the, quote, follow the money loop. Raising capital leads to buying hardware. The stock is up over 100% off the lows and provides a non-US way to express the build-out thesis. Broadcom and Marvell are focused on custom silicon. Broadcom is the blue-chip way to own the custom silicon theme with lower beta. Marvell is about 1/10 of Broadcom's market cap, offering higher beta and more upside per dollar in a similar custom silicon arena. Alphabet's $80 billion TEL includes a large equity raise for AI capex and a $10 billion preferred slice for Berkshire. The stock dipped after hours, but this capital raise is the engine of the entire arms race thesis. Microsoft, Meta, and Oracle are down, not due to fundamental weakness, but because the arms race forces them to spend more. This is an essential read for understanding the current market dynamics. Palantir bottomed on a stable base and broke the wedge, suggesting a software reversal. Resistance clusters are in the low 160s. Breaking through that could lead to a fast move toward 207. Palantir is the flagship for this software reversal. In software movers, Monday.com is up 14% off its bottom, nearly doubling. UiPath is up 10%, finally proving itself as an AI beneficiary. Axon is up 5%, and Intuit is up 8.7%, showing broad strength across various software names. Other software movers include Okta, with an insane post-earnings move higher. Snowflake's reversal is complete after earnings. ServiceNow is showing a reversal has begun. Autodesk is attempting to base around 214 and 215. In cyber names, CrowdStrike has gone vertical without fresh M&A. Palo Alto is part of the same Fortnite cluster of leaders. These four names account for about 40% of CIBR, amplifying the move. The squeeze potential is live. The CoreWeave-style IPO short is a classic overpriced new issue, initially priced at 180 and re-rated to double overnight. A short position was established in the high 200s, fading on the anchored VWAP. This playbook, similar to Coinbase and Rivian's debuts, has delivered a drop. Rocket Lab is struggling to hold 100 and had to be closed. Most of the value in the space complex resides in Starlink, which attracts attention. Other UFO names only look cheap if SpaceX price is high. Watch for divergences. Avoid buying the whole sector blindly. Taylor Morrison surged 22% on a 20% buyout premium. This $6 billion builder is one of the country's largest. This move follows Berkshire's positioning in Lennar, indicating that smart money is expressing a long-cycle housing thesis. The Movers Board highlights various stocks and their recent performance. We can review these movements to understand the current market momentum and relative strength. Here we focus on single-name levels to watch, which provides a playbook for trading individual stocks based on specific price levels and technical indicators. The stock read synthesizes the market into leaning long and fading/caution categories. Longs include AI semi-leadership and capex beneficiaries. Caution areas include laggards and overpriced new issues. We move to the three pillars, where we restack the whole tape through the lens of macro, positioning, and technical structure. Pillar 1 covers macro, the weather system, which is the regime everything else trades inside. The macro signals are loud today, but the tape seems to be ignoring them, particularly with geopolitical risks and upcoming economic data. The Iran and Hormuz situation is a live wire. Negotiations stalled, and a blockade of the Strait of Hormuz was threatened. This puts both key sea routes for Middle East oil at risk. The market is betting on a peace deal that may not arrive cleanly. Crude oil saw a significant intraday spike of 7 to 8% on the blockade threat, closing up 5.7%. This wasn't a fade, but a genuine bid. The price is coiling in a triangle, and a break could trigger an oil shock, a classic late-cycle event. The 10-year yield is coiling in a multi-month triangle toward a potential break above 5%. A break above 5% would change the entire market conversation, fueling the narrative that the Fed has lost control. Yields and oil together form a macro detonator. This scene is titled the Catalyst Calendar, which is part of the Macro Pillar 1 section. The calendar outlines key upcoming events that could act as catalysts in the market. The macro verdict concludes that the current regime is fragile, resting on a peace deal assumption. Two macro detonators, oil and yields, are coiling. A cluster of catalysts is approaching. We advise carrying protection, respecting the current level, and not being overly aggressive into these catalysts. Pillar 2 focuses on fundamentals, which we call the fuel. The main idea is that price rises until earnings roll over, not just until valuation seems high or a bubble is called. Stock price moves while earnings are rising. Price often rolls before earnings actually peak, but we are not at an earnings peak yet. Calling a price too high is similar to calling a home run foul. We are debunking the circular spend critique. The idea that hyperscalers are just funding each other is challenged by the reality of a competitive capex arms race, where nobody can afford to be outspent. The spend is real and happening now. The concept of valuation, or the home run fallacy, highlights that price alone is not a reason to short strength. The market pays up when it believes the next quarter will be better. We should focus on whether earnings will beat or miss, not if the price is too high. The fundamental verdict is that the demand engine is intact and escalating, and the structural bull case is alive with rising earnings. Software monetization is the next phase. The main risk is any crack in forward guidance. We advise staying constructive while earnings climb and watching guidance closely. Pillar 3, technicals, is the trigger, turning a thesis into a trade. We review where to act and where the assumption is wrong. This uses structural analysis to inform trading decisions. We recap counts and divergence. The bearish structure relies on exhaustion counts and non-confirmation, divergence. This combination is powerful for bears, but we must wait for a clear trigger before acting. Intraday opens and gap fills are where positioning occurs in this tape. We emphasize watching the first 3 to 5 minutes, and if the price cannot reclaim the open in the first 30 minutes, it provides orientation. Always mark the opens and prior closes. Regarding tactics, we recommend anchoring the volume-weighted average price, or VWAP, to the IPO print for new issues. For candle reads, look for signs like a doji at a key level or a hanging man after a run, especially in confluence with counts. The technical verdict shows bearish structure is stacking but not triggered. The trigger is a close below the daily counts invalidation level, which is S&P around 7,470. Until then, breakouts get the benefit of the doubt. We must be mechanical. The level decides, not the narrative. The lens section covers confluence, where the pillars meet. The key is that a hollow point shot occurs only when all three pillars, macro, fundamental, and technical, point the same way. The playbook summarizes our strategy. Trade the level, manage the risk, and repeat. We are bound by rules and feared by trade. This final scene presents the Master Levels Dashboard, providing a comprehensive overview of the key market levels for the playbook. Let's review the game plan with two key scenarios: if bulls hold and if bears trigger. If the bulls hold, we lean on long rotation winners like AI semi, software, hardware, and cyber stocks. Conversely, if bears trigger, indicated by the S&P closing below approximately 7,470 in momentum loss, we quickly de-risk and raise cash. Here are the key catalysts ahead. In the next 1 to 2 days, we are on reversal bar watch with the daily 9-count completion. The end of the week brings the jobs report, a critical rate and growth read. Later in June, be aware of the CPI for inflation risk and the potential SpaceX IPO for supply caps and space names. Anytime, Hormuz or oil could be a tail risk detonator. Our risk rules are bound by rules, not emotions. Define the invalidation level before entering a trade. Position smaller around major catalysts like CPI, jobs, or geopolitical events. Always carry protection when it's cheap and there's a known shock window. Finally, be mechanical, bound by rules and feared by trade. The Hollow Point read covers macro, fundamental, and technical views. Macro concerns include a fragile regime, oil and yields coiling, and clustered catalysts. Fundamentally, we see a capex arms race, rising earnings, and software monetizing. Technically, we monitor counts plus divergence, breakouts on volume, and look for the 7,470 line to trade the trigger. Remember, dull entries miss the mark. Hollow points always expand. Connect with Hollow Point Trading via our website, YouTube, Substack, and Discord. Thank you for watching this video. All commentary is for educational purposes only and is not financial advice.